Okay, let's jump into our financial planning topic. I don't see any questions. Let's just check here. Okay, so today in our financial planning topic, we're going to talk about bonds. So raise your hand if you can see my whiteboard. Thank you. And as always, I'm gonna put this on flat on my desk, and I'm gonna write on it. So you're gonna see me looking down. Oh, I didn't tell you in my intro, we have a new financial advisor joining the firm in October. So I'm very excited. She's also a CFP. She's also involved in the Ed Slot group. So she's very new to the Ed Slot Elite Advisor group. That's how I met her. And we started chatting, and we found out, discovered that we had some things in common that we could do together. So she is joining our firm in October. So excited about that. And we'll have her on a webinar to introduce her to everybody. So if you're an existing client, you'll continue to work with us. Don't worry about that. But she will do some things on her own, and we'll help with that. So let's talk about bonds today. So the first question, of course, what are bonds? So bonds are debt, right? So it's debt that's issued by either governments, very simply, governments or companies we're talking about. So any organization that can issue public, we're talking about public debt. So they offer bonds, they issue them to individual investors, and they pay interest on those bonds with the promise that you're going to get your money back, right? So who issues bonds? So I talked about this, right? We have governments and companies. So what we're going to talk a lot about today is the federal government. So the federal government offers different types of bonds, but we're going to talk about treasury bonds today. And any company, again, if I had a publicly traded company, I could go through the process of issuing bonds. These are all registered through the SEC and the regulatory agencies. And then the company, could issue bonds. And there's all different kinds of company issued bonds. And it's not unlike anything else. The company issues the bond, and then the interest rates that you receive. So, for example, most bonds are issued in $1,000 increments, and you might say, okay, I'm going to loan. This is what you're doing. For example, I'm going to loan the federal government $1,000, and I'm going to. They're going to keep my money for a period of 1 year. And today, if you did that, let's see, I got the rates here. I don't have the 1 year. Okay, so we're gonna change that to 2 year. The 2 year treasury is at 4.2%. So I'm going to loan the federal government $1,000 for 2 years now. And what did I say? It's 4.2%. And over that time, I'm going to get interest payments of 4.2% a year. At the end of that 2 year period, I get my $1,000 back, right? So you get the interest along the way. Then you get your $1,000 back at the end of those 2 years. So that's how that works with a federally issued bond, or any bond for that case. Now, municipal bonds, that's a type of government bond. They're issued by local municipalities. They can really be for many things. So when I was on the Council Rock School Board, we issued bonds to build schools. We did a lot of that. I think we were close to $100 million in bonds for the schools that we did renovations and buildings for, and we would pay interest on those bonds. Now, many times, as you know, municipal bonds that are issued by your local municipalities can be tax-free. So you don't pay federal tax, state tax, and local tax if you buy them within that jurisdiction. So it would, in this case, if we're here in Pennsylvania, Council Rock, if you're a Pennsylvania resident, you wouldn't pay state tax, you wouldn't pay federal tax, and you wouldn't pay potentially local tax. So that can be very beneficial, and those rates tend to be lower because you get that tax, you don't pay tax on that interest. But as you know from our teachings, that that interest that you receive on those tax-free, air quotes, municipal bonds do factor in the taxation of Social Security. So they're really not completely tax-free. So interest rates are determined based on what? They're determined just like an individual based on credit quality. So the US government is considered the safest credit quality, right? At least for now. So that's why you typically get lower interest rates for, and you're going to see that in a moment, for US government bonds. Actually, let's share that. So you'll see here where here's the 2-year treasury. And here's a 10-year treasury. Now look at this. The 2-year treasury, you get 4.2%. That's for holding your money with the US government treasury for 2 years. You get 4.2% along the way annually. If you put your money in with the federal government for 10 years, you get 3.68%. So that's a challenge we're in right now. We're going to talk about that. Would you want to put your money into the US Treasury for 10 years at 3.6% if you could just hold it there for 2 years and get more interest? Probably not for most people. There may be reasons to do that, but probably not for most people. But let's look at what this means, and I'll explain all these. So this is Bloomberg, Barclays, investment grade corporate bond index, right? Or where their bonds closed. So closing the last week, 9/23, so that's Friday, they averaged, so this is average, right? Average interest rates was 5.1. So better credit quality here of the US government than of the, this group here, this collective investment grade. That means higher quality companies, bonds. So you get more interest for taking the risk associated with investing in these types of bonds compared to the US Treasury. Really no risk. Your $1,000 that you spend on one individual bond with the US government is certainly going to come back to you if you wait two years. You're not guaranteed to have that has the full faith and credit of the US government. You don't have the full faith and credit of the US government with individual companies. So you get more interest for taking that risk. Now, high yield, this is the same Barclays, Bloomberg Barclays, high yield corporate, right? So these are private or publicly traded companies. High yield is lower credit quality bonds. So they might just have, their books aren't as strong, their revenues aren't as strong. So look at, you get 9.25% annual for that, but you're taking more risk with your money. You're not guaranteed to get that money back at any point, right? So you're taking more risk. You're likely to get the money back, but no guarantees. And this is what I was talking about muni bonds. You see municipals, 3.87%. So you get a little less than the 2-year here. Actually, this should be less too. Interest rates are just crazy all over the place because you don't pay, as long as these are structured properly, you don't pay tax on that interest. Of course, they could contribute it to your Social Security being taxed, but you shouldn't pay tax on that interest for federal and state, and depending if you're buying it in the state where it's issued. I know it gets a little complicated. So, and then high yield munis, there can be lower credit quality municipal governments and you get a higher rate of return. But again, you're taking more risk that your full amount that you invest in there won't be returned to you. So the safest is commonly known as the treasury. So any treasury note, you can get those funds back. I see a question, or you will get those funds back. Walter mentions U.S. government I bonds. I don't know if we have time for that today, Walter, but we can talk about that at another time. Good point. You can see that we have a 6-month treasury here, and I'd have to look up what the 1 year is done with. Even as the 6-month is 3.86%. Let's look where it was a year at the end of the year 2021. It was at 1.8%. 1 year ago, this time last year, same day, it was 0.04. So you can see just how much interest rates have increased. since last year. The 2-year is 0.26. Now it's 4.20. The 10-year is 1.43. Now it's 3.68. So massive increase in a short period of time. And it's partially driven by the Fed, of course, right? The Fed continues to increase interest rates, but it also is just driven by the markets. The Fed can't put a cap on where the markets are going to go as far as interest rates. And so that's why sometimes you see, the run up of interest rates, and then the Fed might stop increasing the Fed funds rate. This is what when you hear about the Fed increasing, this is what they're increasing. But the markets might just take over and go right through that, which is what we're seeing now. So the last mortgage rate I saw last week at my credit union when I stopped in there was 6.125%, which is much, much more than it was, a year ago, of course, or even really 6 months ago. So this is where consumers really get hit. Of course, this is where investors really get hit, right? Because this is the other part of it. If we know that interest rates are going to continue to go up, are many people going to put money into a 10-year treasury that's paying 3.68% when they can own a 2-year treasury that is paying 4.2%? When we know that if the Fed continues to raise interest rates, if they raise another, 1, 2, 3% over the next 12 months, who the heck knows? These rates will continue to push up. Now, let me explain what I'm talking about. So my next point is, are bonds safe? So I think we understand interest rates right now. What are bonds? We talked about who issues bonds. Now, are bonds safe? We talk about this a lot. People consider bonds as a safe alternative. You've heard me talk if you're a client, you've heard me talk about this for years. If you're attending the webinar, you certainly have heard me talk about it since we started these in March 2020. But why are bonds, I think, one of the riskiest asset classes and investments going forward? Because this is what happens. I'm going to come back to this yield curve. And here are some of the losses I talked about, and why it's so perfect segue or discussion item in this. Here's your average. Here's where your average bond investor lives, right? And your safe investments have produced a negative 13.75% return so far this year. Why is that? You see, even the shorter term, 1 to 3 year bonds down almost 5%, 4.5%. Well, this is why. Remember, I said you buy these bonds at $1,000 increments. And let's go back and use the actual numbers here. And let's say a year ago, you bought a 2-year treasury. So in what's today? On 9/27/2021, you bought a 2-year treasury bond that matures then on 9/27/2023. And that bond that you purchased, let's go back to that rate, was 0.26%. So for that period of time, holding that period of time, you're receiving 0.26% annually, right? So you get an annual return. You get paid periodically, but you get an annual return of 0.26%. Well, now here we are 1 year later. So now let's sneak this in here, right? We're at 9/27/2022. And let's say you have $100,000 in these bonds, and you say, well, wait a minute, I am getting 0.26% on these bonds. I have another year to hold this. I can now get 4.2. Is that what it was? 4.2%. Why don't I take this money and sell it and buy for a bond now in 2022 at 4.2%? Well, who's going to pay you $100,000 on bonds at 0.26% when they can go out and get brand new bonds on their own? I had one extra 2 here at 4.2% in 2022. Do you follow me? So what's going to happen is if you sell this, and this is why you see this $100,000 may be worth, there's a calculation you could do to see exactly what it'd be worth, but it would be significant. This $100,000 might be worth $80,000 on your statements. I'm not sure if that would be dramatic, that dramatic, but let's just use an example. Because if you sold that in the open market today, people are going to have to pay a discount on that value to get anywhere near the same type of earnings, right? Because they have to make up that 4% difference, and they have to make it up in a year. So actually the discount might be steeper than that. I should have done that calculation, because I bet it's shocking. So that's why bonds it can be risky as interest rates go up, because you're holding these bonds, and as interest rates go up, the bonds that you have are becoming worth less and less and less, because 1 year is no big deal. You can wait another year and you can just receive your 0.26% and then just rebuy new bonds if that's what you want to do, and you'll be getting them at the higher interest rate. But what if you have one of the 10-year treasuries that was, at 1% when you bought it a year ago, and you had to wait 9 more years to fully get your money back? And that's where the trouble lies, because you may be able to wait 9 years. It may make sense for you to wait 9 years, or you might just say, I'm getting hardly nothing for this. Inflation is at 8.3%. I'm getting 1%. I need to do something. So that's what the issue with the pricing of bonds. Now, you just might say, well, that's okay. That's a portion that I can just hold on to. Why would I sell that and take a loss? I can't. And maybe they're in your retirement accounts and you can't take a loss for a tax effective, or you can sell it at a loss, but it's not going to help you on your taxes. And that might be a fine strategy, just holding those bonds to maturity. But most people don't buy bonds that way, do they? No, they buy them in mutual funds or exchange traded funds, or ETFs. And these are priced every single day. And in the case of ETFs, they're priced all day long on the open market. So we're getting accurate pricing on these bonds within the mutual funds and ETFs. And frankly, they're traded all the time, right? So it's not like you can hold something to maturity. Mutual funds and ETFs have like a perpetual maturity. So you don't have control over those individual bonds. And that's why you're seeing these mutual funds and ETFs that hold bonds that are down. And frankly, I think that downturn and that climb away to where we start seeing positive returns is going to be much longer than the stock market. So, okay, it is 10:50. We've covered, I didn't do my switch over during our financial planning topic section, but that's okay. But we've covered some market thoughts today, market activity. We've talked about some items from the slot report. And for our investment fundamentals, we talked about what are bonds, how are they priced, what are some of the risks, what are some of the rewards. We talked, the rewards. I talked a lot about the risks. The rewards are, of course, if you own treasury bonds and you own them individually, you're always going to get your money back unless the federal government defaults, which is very unlikely. Determine the credit quality of what you're using. You can get really caught up in just looking at funds or individual bonds and what their past 3-5 year numbers have been. So just pay attention to those credit qualities. There's how long you're going to be holding those bonds for. Even what I don't want to get into it too much, but what we call duration, how much the real life of those bonds are. So I hope that's helpful. This is meant to be on a very, very high level, just to give you some exposure. We didn't get to talk about the inverted yield curve, which you can see here. This is normal, pay less interest in early years, and as you lock yourself in for later, longer periods of time in your investments, you typically get more interest. Here's what we're seeing right now. As you saw, we get higher interest in the shorter term and less interest in the longer term, and that is what we call an inverted yield curve, and that is not a good sign for the economy, and certainly for the idea of a recession. So that's it for today, folks. I do see a question. Doug asks, are you better buying individual bonds rather than mutual funds to be patient? It all depends, Doug. So it depends on your situation. If you can find bonds that fit your situation, and then you've got it. This is where account segmentation comes in, because you don't want to buy a 10-year bond for money that you're going to need in the next 3 years, let's just say, because you may not have the ability to hold that bond for 10 years. Now, we're in an unusual situation right now because of the way interest rates are, where you're getting less interest for a 10-year bond than you are for a 2-year bond. So most people aren't chasing that higher interest, but that's typically what people do. And the yield curve will correct at some point, and people will find themselves saying, well, I probably won't need this money for 10 years. And I want to get a higher interest rate. But you really have to plug these into your account segmentation, and that is having a defined pot of money or investment strategy for each portion of your life. So if you have questions, we can talk live, Doug. But good question. We'll see everybody next week. I hope this was helpful. Take care. Enjoy the rest of your week. Take care.